gotten a lot of questions. I know we've done previous episodes, but just trying to clear up the misconception that may have arrived.
In last week's video, we talked about how you can get 3% mortgage rates in today's market, and today's video is clarification of what that means, what that does not mean, and a little bit of insight into what's going on and how the loan industry is set up and organized, all for your educational benefit. Christian, welcome to BiggerPockets YouTube.
Appreciate you having me again, David.
We're going to be talking about ways that people can save money on their loans as well as their interest rates, because that's what everybody wants to know. At the One Brokerage, we have some products that we've created relationships with different lenders so that we can help our clients save money. One of them is working very well for a certain class of investor. Can you tell us a little bit about the buydown products?
So these products, they are conforming products, and they're referred to as the 3-2-1, the 2-1, and the 1 buydown. And all those are referring to is the increments of the interest rates that you could save temporarily. These loan products are super valuable, especially for purchases, for people who may otherwise be getting a 6% plus, who want to get temporary savings of a 1, 2, or 3% interest rate. What these products essentially are, the seller credits the buyer, whatever, 2, 3%, whatever a percentage of your purchase price is. This is why it's important. Communicate with your realtor, get them linked up with your lender so they know how much they have to request to get this product. This product temporarily buys down your interest rate with the credits from the seller. In our instance here, if your rate was going to be a 6%, elected for the 3-2-1 buy down, and you got enough seller credit to pay for that expense, there's going to be a 3% savings in the first year. So your first 12 months, you're going to pay an interest rate 3% less, then 2% less in your second year, then 1% less in your third year. And the most common questions that we've gotten is, number one, is this an adjustable rate mortgage? Because the interest rate's technically adjusting. It is not. It's the seller prepaying the expense up front for you to save over the course of your first 3 years. And if at any point in time in those 3 years a refinance opportunity takes place, all of that money is not just spent. It's basically sitting in an escrow account that the seller set aside for you. If you normally took that seller credit and chose to just buy down your interest rate, in the same way you've always been able to, you just buy down your interest rate from a 6 to a 5%. That money's gone if you refinance. So if you go refinance in a year and you go get a 3%, that money is wasted. It's cost of operations. This money is not. It actually sits and it's reserved for you so that you can use that to potentially get a free refinance later, or maybe even money in your pocket, some cash back potentially. Okay, so it's an advantageous product to get a temporary reduction of your interest rate while still sticking to a 30-year loan. Okay, so it's a really powerful product. Second misconception, this cannot be packaged with like a DSCR loan, another loan that people reach out to a lot. It cannot be packaged with a HELOC. It cannot be packaged with a hard money loan or a bridge product or any of these other products. This is a conforming loan product. So this is full document qualification, everything in that regard.
Let me make sure I understand what you're saying. So let's say that I normally would apply for a conventional loan and I'm quoted at a 6% interest rate on that property. I have the option, if the lender I'm working with has this buy down product, to say, okay, instead of paying 6% in my first year, my loan's going to be based on 3% interest rate. Then it's going to go up to a 4%. Then it's going to a 5%. After the third year, it goes back to the 6% that it would have been from the beginning, the number that I was actually qualified on. So it's not an adjustable rate mortgage in the sense that every year it can go up. It's more of a fixed rate mortgage that gives me a bonus of lower interest rates for the first 3 years. And the seller is the one that will pay the money to be eligible for this program. Is that correct?
That is absolutely correct. Perfect explanation. And this is something that realtors are having a lot of success negotiating. So those of you who are saying there's no way I can get credit to buy this down, we're doing it every day. Make sure you have the conversation. If you're not having the conversation, none of this is going to happen. Make sure your realtor understands the product. If they need to know about it, reach out to us. It's a powerful product that gives you significant, you guys calculate 3, 2, and 1. That's 6% of your purchase price over the first 3 years. That's not minimal savings. That's significant. So make sure you understand the product and if it qualifies for the loan you're looking for.
Now, you are also just starting to mention before I jumped in there, this does not apply to investment property non-QM products. This is only for conventional loans. For someone who doesn't know the difference, can you briefly break down what a conventional loan is versus a non-qualified mortgage?
Yeah, awesome question. This is what we've gotten a lot of questions for, and I'm glad we finally get to announce it. If you guys think of lending kind of on a spectrum, right? On the farthest, most conservative, like let's say the left-hand side of your chart, you have the clean stuff. That's your Fannie Mae, your Freddie Mac, your FHA, your VA. We call that the conforming loan space. All that really means is that it conforms to government guidelines that have been set in place to calculate debt to income ratios and down payment requirements and what minimum FICO score you can have. FICO is just your credit score.
And the reason it needs to conform to those government standards is because the government insures these loans. So when you get this loan, the government then says, okay, we will make sure that somebody buys this or we will buy it ourselves. And then it ultimately gets packaged as a mortgage-backed security. So that person who's buying it as a mortgage-backed security wants to know you are giving this to people with credit scores of 250 or debt-to-income ratios that don't make sense. So they conform to government standards because the government is ensuring this, which is one of the ways the government makes sure that loans keep being given because there's always buyers for previous loans.
Correct, 100%. And that those conforming loans are the strictest in the industry in terms of underwriting. So that means they get the best interest rate because there's the least amount of risk, right? And everything in lending is risk versus reward, right? So since this is the most critiqued underwriting, debt to income, everything else, lowest interest rates. Now you go a level above that. So now this is a different loan product. This is not conforming anymore. Remember that conforming space is where the buy down product is. Then you get into what we call non-conforming. Pretty simple. This is everything our DSCR loan that we created is involved in this box. This is anything that still has some underwriting. So for instance, the DSCR loan underwrites the income of the property instead of the income of the buyer. Other options are like alternative documentation. So you can qualify with the income from your bank statements instead of tax returns. That's really good for like realtors and people who write off a lot of business expenses because the money you made in reality is probably different than what showed up on tax returns. But a little bit more risk for the lender because you're lending to people who didn't report taxes the right way or whatever the case is, okay? That's kind of the second realm of lending. If I were to just break them up into three, the last realm would be like your bridge, your hard money, your private money. Typically, there's very little underwriting. They don't care if a property cash flows. It's mainly an asset-based loan. And all I mean by that is if you have a down payment and you have a plan, the lender will give you money. Obviously, for those of you who are familiar with those loan products, you'll know those are the highest interest rates because there's the least amount of underwriting. There's the highest risk associated with those. Those are like your 10, 11, 12, sometimes 15% interest rates that have very minimal underwriting. And obviously, that's what leads to the higher rate. Usually higher down payment requirements as well because the lender wants you to have some skin in the game, right? But yeah, that's a nice little breakdown of just where each loan may fall in the realm of things.
I love when we do that, when we zoom out and we get sort of the big picture. It's similar to when, if you imagine that you're in a battle and you've got bullets flying over your head and mud kicking up all over the place and people screaming, it's very hard to see more than what's right in front of your face. Versus when you get up in the helicopter and you see the whole thing, you're like, oh, this makes a lot more sense. This is way less complicated than it seemed when I was in the trenches. We get this stuff thrown at us, FHA, I think I almost said VHS right there. That would have been funny. Second home, vacation properties, 15% down, 20% down, 5% down, 3.5% down, 0% down, USDA. It's like being in the middle of the battle and you just have stuff zinging all over the place. You don't know what to make of any of this. But when you understand that there are conforming loans, which are the conventional, the FHA, the VA, I guess USDA would probably fit in there. We didn't mention that because it only applies to certain areas, right? And then you've got non-conforming, but that doesn't mean that they're subprime crap. They're still 30-year fixed rate. You're not getting an adjustable mortgage. There's not a balloon payment that's coming up due. But those are definitely risky because the government isn't insuring them anymore. If the lender makes a bad loan, they just eat it. There's nothing that can be done. So they're going to need a higher down payment. It can really help investors understand where to start, how this journey is going to progress along the spectrum, what they can expect to where they're going, and then what different real estate investing strategies, be it short-term rentals, BRRRRs, flipping, house hacking, right? All of those strategies tend to have a loan that works best for them. So depending where you are in your journey, it's not that complicated if you just talk to us and say, here's what I want to achieve. And we say, okay, well, here's where you're going to start. And this is going to be the bike with the training wheels or the tricycle. And then you're going to move to the bike with the training wheels. And then you're going to move to a bike. And then here's what the motorcycles look like. But you're not going to get out of motorcycle until you've already learned how to do these things. The whole thing doesn't have to be as scary. Kristen, I know you've talked to a lot of our clients and have come to you with a bunch of questions. What is the thing that you wish people understood more than anything else before they start getting into financing real estate?
Not all advice is for all clients. For instance, I was just thinking when you were talking, they're adjustable rate mortgages. For instance, I have one. I have an adjustable rate mortgage right now, and I'm utilizing it correctly. I would not recommend it to a first-time homeowner or even, honestly, a 2 or 3 or 4 or 5-time homeowner. This is something for an experienced investor who knows how to asset protect and who knows how to leverage and who understands the cash flow and all that. It's just, there's too many lenders who will sling any loan that fits, right? And, oh, it works? Okay, let's do it. especially when you go, and this is not speaking ill of anybody, but when you go to a lender that has a smaller subset of loans that they can offer, it doesn't have to be us. Once again, guys, just speak to somebody who's familiar with multiple loan products, a broker, somebody who has access to different banks. You're not always going to fit in the same. I mean, the first loan that I did for you, David, is significantly different than the last loans we did. I mean, they're completely different loan products. And if we were only with one lender or one institution, I wouldn't have been able to help you grow your portfolio that well, right? I couldn't have grown mine. If you're seeking advice, just make sure that the source of that advice is reasonably prepared to give it.
Yeah, it's a really good point. If you go to a Toyota dealership, they're only going to sell you Toyota cars.
Correct.
You go to a Honda dealership, all they have is Honda cars. And this, I mean, to make the analogy more accurate, it'd be like you go to a Honda dealership and all they have are Accords.
Yeah.
They don't even have a Civic. They don't have anything other than just that. And they're going to try to tell you why the Accord is the best thing around or keep you from looking at any other cars. Then you feel the pressure to go to the Toyota dealership, then the Honda dealership, then the Jeep dealership, then the Buick dealership, and you're going all over the place versus going to one car lot, maybe like CarMax, that has many different kinds of cars there. You can look at all of them. You could talk to a person, tell them, I have this many kids, I need something that gets this much gas mileage, I need this many miles on it, whatever it is. They can line you up with the right car. It saves you a lot of time and takes a lot of the pressure out of trying to compare 19 different loan products from 19 different people and getting stuck in that analysis paralysis that we really want to avoid. This is also something that Christian and I have frequent conversations about on our Discord channel, DG's World. And if you guys would like to join that and see what's going on behind the scenes, you can reach out to me or Christian and just say you'd like some more information, and we will send you a interest sheet that you can sign up for to learn more about it. People that join that get access to me, to Christian, to different loan officers, to different real estate agents, all kinds of people to ask these questions so that you don't have to go to a million different dealerships. Lastly, don't forget that BiggerPockets is more than a YouTube channel, and it's more than just a podcast. We have tons of stuff on there. There's a real estate agent finder. There are calculators to run numbers on deals. There are forums where people are talking about different loans they've got and what kind of experience they had. And there are people that are discussing different questions they have about different areas they're buying. There's a lot of information out there that you can go and look up that is more than just listening to this. So if you have some time, head over to biggerpockets.com. Check that out. Christian, where can people find out more about you?
Absolutely. I'll package onto that. At BiggerPockets, if you search my name up on BiggerPockets, my account will show up. I check it. I monitor it all the time. Shoot me a message. We'll talk. We'll talk our loan products. We'll get you connected to one of our loan officers. We'll take you from there. Our company can be found, theonebrokerage.com, all spelled out. My email is also christian@theonebrokerage.com. If for whatever reason you're listening to this and you don't have a BiggerPockets account, which I would question your decision making at that point, but I just want to challenge everybody. If you guys have a question about real estate, log on to the forums, search it. Somebody's asked it. I can almost promise you. So there's answers in there. There's people who monitor the forums. Get on there, get involved with your network, ask some questions, get some answers. It's an awesome place.
All right, make sure you do that and let Christian know how his hair looks in his BiggerPockets profile versus how it looks right now.
Very different.
And lastly, before you get out of here, make sure you hit that bell to get notified when more BiggerPockets videos on YouTube come out. We want you to be here with us every time we do a Mortgage Monday so you can learn about what's going on in the mortgage industry, how to finance your deals, and what hacks are available out there to save you money. Do that, and then please leave us a comment on today's YouTube video to let us know what you thought. Was this something you didn't know? Did you learn something? And are you glad that you watched it? I'm David Greene 24 on all social media or davidgreen24.com, and don't forget to check out biggerpockets.com. We'll see you on the next one.